Welcome to the Roy Matlock Jr. Money and Business Hours, where he'll help you fix your finances once and for all. To reach Roy, call 615-843-2999. That is 615-843-2999, or visit RoyMatlockJr.com. Now, here's your host, Roy.
Right, Roy Matlock Jr. here, and we are today, once again, as always, going to be talking money, and always, I'm very observant, and I see things happen, and I go into the same Starbucks every morning, and I looked and I saw the manager, and I said, wow, I've never noticed this, because I just faced her, forward, and she's pregnant, and I was like, I remember the days back when that happened, and when I had my first child, and then I had a buddy of mine that runs a restaurant here, and found out he was having another baby, like right then, and I thought, wow, things just keep going on. And so today I thought, why not talk about, to the young people, what you need to be thinking about when you have a new family, maybe you're newly married, and if you've got kids or possibly even grandkids that are like that, this will be a good show for them, where we're going to talk about a getting started financial plan and just really keeping people young from making the bad choices early on that will, end up costing them between $50,000 and $500,000 over their lifetime by making mistakes. And you say, how does it cost that much? Well, what happens is anytime you take your money is not just sitting. You can spend it or you can invest it. So let's take $10,000 and let's blow it. All right. And so you blow the 10 grand, and then you say, well, what if I didn't blow it and I get 10% on my money every 7 years? Then it's going to double. And if I've got 30 years or 40 years, if I'm very young, say 40 years to retirement, and I take 40 divided by 7, that's 6 doubling periods. So the first doubling is 20, then 40 is then 80, then 160, then 320. Then that costs you $640,000 by blowing the 10. And so what we're going to do today is talk about not making bad decisions and getting on track and putting yourself in a position to win, financially. And that's, what I've been doing this for 40 years. So back in my 20s, I made some mistakes before I knew what I was doing. And then from there, it cost me. And, we want to avoid that. So let's get into that. So getting started, there's 4 basic focus points that I tell people that we want to do. The first one is we want to grow our income. And by age 30, you should work to find something you like to do. That's number one. You got to like it and you got to love it. It's got to be not a job. All right. It's got to be something that you feel good about, that you get up and go do it. It's kind of like a hobby. People ask me all the time, they say, are you ever going to retire? I said, no, I'm never going to retire. Why would I retire? I have fun doing what I'm doing, and I may slow down. It's not like I don't have a great life already. I get to, plan my own time and do my own thing, play a lot of golf, all that kind of stuff. So I have the time freedom, but the reason I have the time freedom and the reason I have the ability to do things, I found something early on that I like doing. I liked helping people get their finances straight. And so by doing that, if you find something you like, you then will become good at it because you like doing it. You're not looking at the clock every day trying to figure out when you can leave and stuff like that. And I have people all the time, they say, why don't you retire? I'm like, why would I? And most people that tell me that, they say that because they don't like what they're doing. And as a result, they want to quit. All right. But that's not me. And so if you find something like that, the second thing you do is you work to become the best at that, and you become self-employed. Now, that's the real answer to where you take your skill set, you become great at it, or if you go down the corporate route, you just start changing jobs because it tends to be that companies, they don't pay you to keep you, they pay you to get you. And then after that, they kind of neglect sometimes, and then that's why they lose some of their best people. So anyway, with that being said, that's the first thing. We're going to grow our income. The second thing we're going to do is we're going to have a defensive game. A defensive game is to play with a goal of not losing. We're not going to mess up early on. And so when we think about that, We're going to have budgets. We're going to make sure that we don't get into bad debt, know the difference between good debt and bad debt. We're going to make sure that we have things to protect our income and our assets. That's meaning insurance. For that, we are mainly going to be focusing on, money management skills. The number one thing I see that will help people more than anything is to have a usable budget, a spending plan to control spending in advance rather than an accounting system to look at all the money you spent and there's nothing left. And so we do that. We're then going to probably shoot to get a home. Home ownership is the big goal. We want to buy it right. We'll talk about that. And then you want to get to a point and save $100,000. Now, if you're starting young, say you're in your 20s, early 20s, and you're doing this, get to $100,000. That's what we want to do. We want to get there as quickly as we can, because then our doubling period, starting at age 30, if we have 5 doubling periods and it's $100,000, hey, we're starting to move in a positive direction. And I say 5 doubling periods and $100,000. That's the rule of 72 is part of what you need to learn, and that is how long it takes your money to double and why we want to get a better rate of return. And it basically says any interest rate divided into the number 72 will tell you how long it takes your money to double with compound interest. So if you are getting 10% on your money, the S&P has averaged that forever, then you're looking at doubling your money every 7 years. But if you get 2%, like at a bank account, it'll double in 36 years. So rather than having seven doubling periods or 6 doubling periods, you're going to have 1 doubling period if you just go and you loan your money to the bank. And so we're going to work on getting ahead by having more coming in than we have going out. We're going to work on growing our income, and then we're going to keep from making bad mistakes, and we're going to move toward $100,000. And so that's going to be the show today. If you're just tuning in, my name is Roy Matlock Jr. We teach people how to get their money straight. And we do lots of things educational. If you go to roymatlockjr.com and you can check out our seminars that we have, they're not seminars, actually webinars, where you can tune in. We're beginning right now a series. We just did our first one. You can go to roymatlockjr.com, but it's all about education. I believe that if you get educated on your money, you can make good choices. And so that's what we're here for. My name is Roy Matlock Jr. Visit Roy Matlock Jr. Tune into our previous shows on our podcast. We'll be right back.
Welcome to the Roy Matlock Jr. Money and Business Hours, where he'll help you fix your finances once and for all. To reach Roy, call 615-843-2999. That is 615-843-2999, or visit roymatlockjr.com. Now, here's your host, Roy.
Right, we're back, and Roy Matlock Jr., and we are talking money, and this is the getting started stage. So if you have a young adult, or maybe it's a grandchild or child, whatever it may be, this is the show to get them started off correctly when they're young couples. When I first got into the business, at my, 25 years old, I'm now 64. I'm dating myself a little bit to tell you how long I've been doing this. But the point being is when I first got involved in this, I had no idea all the things that were going on when it came to your money. And I started teaching young couples. And most all of my client base was young couples, primarily because the young couples, they didn't have any money. I didn't have any money, and we kind of grew up together. And now I have clients that have been with me for 40 years. How about that? And we started from being young and getting started all the way to middle, and then now we're at or near retirement. Some people are retired, and so on. So the 4 key starting points, goals are, number 1, we're going to grow our income, work on our value proposition, with the idea that as you grow your income, you're going to live on 75% of the money. You're going to take 50% of it is going to go to you, 25% of it is going to go to taxes, more than likely, and 25% is going to go to savings. So if you start out, you don't make bad decisions, and you're making $100,000 combined, and you got $25,000 a year going into an investment account. In 4 years, you have $100,000 saved. And while you're doing that, you're working on getting your income to grow because you're paying attention. You found something you like. You're getting better at it. You're an expert. And you start demanding a bigger income. And so how do you raise your lifestyle? It's real simple. Make 150 grand. And then you save 37.5, and then you make 200 grand. And then you save 50 grand and so on. And you say, well, how do you do that? Look, 200 grand is not a lot of money if you're good at something. All right. So if you get really good at it and you start moving toward owning your own business, become an expert in your field, figure out how to monetize it. Monetize your expertise. That's what you end up doing. That's what I've always done. I remember, I got involved I went 18 years in a row that I made more income every year, 18 years in a row up until the tech crash, and we had a pullback right then. But you think about 18 years of pay increases, and they weren't cost of living increases. They were value increases that I was bringing out to the client base and to the people in my organization. And so as a result, my income went up. And so you think like that. And so then we go to defense. Then we're going to buy the home, set aside money for that, get to the 100 grand. So what do we do to begin with? I've got seven steps that we'll cover now on the getting started stage. So the goal, the plan, the schedule. All right. That's your GPS. What's the goal? When would you like to be in a position? What would it take not to quit, but to be in a position to quit? So I'm going to give you some ideas about, and if you're out here right now, you're not young, you still can, a lot of this, it applies to everybody. The first question is this: if your income went away, how long can you live? All right. That's the first question. And the way you do that, you take the amount of money that you have saved and divide it by the amount of money it costs you to live each month, and you start building months of savings. And what do I mean by that? So if you've got 100 grand and it costs you $5,000 a month to live, then that means you've got 20 months to get back on track earning money. And so what we want to do is we want to make sure that we are thinking like that. We've got 100 grand. It'll be even more than that because it's gaining. But the whole point being is, how long can you live without an income? Not that you're planning on quitting, but the idea is your financial security is going to be built on knowing that you can live this long without ever earning more money. And ultimately, your goal is to be able to live forever and beyond by leaving an inheritance behind because you've saved your money and you've got your money invested. And so the first thing is the goal to plan the schedule. What's the goal? What would we like to have? I would like to retire one day or be able to on 100 grand a year, multiply it by 20. That's kind of your rule of thumb. 20 times that, you need 2 million. All right. And then what's my plan? I'm going to put aside X amount of dollars at X rate of return. I'm going to give you a great calculator that I show people. If you go to sec.gov and just look for calculators, it'll give you compound interest calculators that show you how much you need to save and what it'll end up being, all that kind of stuff. And so then the schedule is, hey, I got a goal in 20 years to do that. I need to set aside this much money. So let me give you an example. If you wanted to save 100 grand and you took that 100 grand and you said, well, I'm going to save 100 grand. And what I'm doing, and this is 100 grand in 5 years. Okay. And we're going to do this at 9%. How about that? 100 years, 100 grand. That's $1,392 a month. All right. So in 5 years, I want to have $1,392 a month. If I get 9% on it, I will have my 100 grand. If I want to save and get to 100 grand in 10 years, it's $547 a month. Now, take that number, multiply that number, and say 547 a month times 12. That's $6,000 a year that I need to be saving to get there in my 10-year period. All right. Or if I want to do it in 5 years, I need $1,400 a month. That's $18,000 a year ballpark. And if you go by that rule of thumb, you're making $72,000. You save $18,000. You live lean and mean, and you're off to the races. So that's the way we go about that. So these numbers you can calculate right on that sec.gov. And we put together plans like that. So that's our goal, our plan, our schedule. And you build a team of trusted advisors. What are trusted advisors? You need to go look. I think you need someone that's great with your health. You need someone that's great with your money. That's what we do. All right. You may end up meeting someone that is a lawyer that you rely on, that so you don't make bad choices. And so what we do is try to put together things like that as part of the plan. Number two, we're going to build an emergency fund and set up a budget. How do you set up a budget? Well, the first thing is you take the total income, you put it into one account every month. You deduct and set up all of your ongoing expenses. What are ongoing? That could be your house payment, any expense that's recurring. We're going to make sure that we got an emergency fund set aside. So the first money that we save is going to go to make sure we have 3 to 6 months of expenses. Then that way we know we've got 6 months. If we have dual incomes, and we might be able to get by with 3 months of expenses. So if it costs you $5,000 a month, you need $15,000, and that's just for emergencies. Why do we have those emergency funds set aside? So we can start self-insuring on things. So let me give an example. If you have a car, you can raise your deductibles from $500 to $1,000 or $1,500. That'll reduce your cost of insurance. Now, if you have a wreck, you're going to be responsible for $1,500 rather than $500, but it's going to save you monthly. You're going to do the same thing with your car insurance. If you're buying your own health insurance, you can raise your deductibles on your health insurance. And so these are things that give you a rate of return on your emergency fund. Always self-insure. You can pay cash in advance on things and get discounts. All right. All these different things that you can do if you have some cash set aside. So we're going to do that. The budget, I'm going to get into more detail when we come back out of the break, because I'm going to give you some simple budgeting tips. But the most important thing that you need to know is that we have to pay ourselves first. And what is paying ourselves first? Well, when I first got involved in this business, I set up a $100 a month fund going into a money market account for my emergency fund. And then I also had $50 a month. I got started on my investment account. And so that was kind of how I got started. How did I do that? I set up a draft. And back then they draft, and they still do it to this day. It's not as much payroll deduction back then. But what I ended up doing was I set it up to where every month it automatically hit my account. I like doing it right around the first of the month when the house payments due or any of the other payments were due. That way I am paying myself first. Most important thing about a budget is to pay yourself first. If you need help with your money, go to roymatlockjr.com, schedule a free 30-minute phone call. We will be right back.
Welcome to the Roy Matlock Jr. Money and Business Hours, where he'll help you fix your finances once and for all. To reach Roy, call 615-843-2999. That is 615-843-2999, or visit roymatlockjr.com. Now, here's your host, Roy.
All right. We are going to get started on the budget. Go to roymatlockjr.com, download the budget forms. That will help you, and I'm going to walk you through how to set the budget up. Today is for young people getting started, but more than anything, not just young people getting started. If you are late in life getting your finances straight, it all starts the same. We build it. We go get our GPS. We set an emergency fund aside, get on a budget. Then we make sure that we don't lose with proper insurance, and we get rid of the bad debt. We save for our home ownership. We start accumulating money, and we have a plan in place to cover our estate in the event something happens. So let's go with the budget. So you get the budget forms out, and what we do is we start out, and if you have consumer debt right now, that would be our credit cards, car payments, stuff like that, and you don't have a lot of savings, that means you're spending more than you make. All right, so that's a simple way of understanding it. If you don't have money and you have debt, you're spending more than you make. So the first thing we need to do on the budget is we need to look at our total gross income. What are we making? All right. So we're making, for the sake of it, easy math, $100,000 a year. And we take that $100,000 a year and we look back and we do a little review session, and you can go back through, payments, credit cards, all this kind of stuff. I use QuickBooks. I've been using QuickBooks for years for my business, and I set aside my personal stuff in QuickBooks, so I know how much I've been spending. I've been using that since 1996. I can go right now to 1996 in my QuickBooks, and I can tell you how much I made and how much I spent and all that kind of stuff. And so why does that matter? It matters because of the fact that if you don't count what you're doing, you'll never get ahead. You got to figure out where you're at. And so let's take a look back, and you made $100,000 last year in the last 12 months, and you didn't save any money, and you look back through and you say, let's fire all of my expenses. All right, so now I got $100,000 and no bills. Which ones will I not rehire? Oh, I don't need this. I don't need that subscription. I don't need that. I got this car that's too expensive. How can I get out from underneath it? All right. And so on. And, my rent's too high or whatever it may be. Maybe I'm eating out too much, whatever it is. But the bottom line is you look back and you say, okay, what is it that I want to fire and what is it that I'm going to keep? And with the idea that there's a gap with the goal of having 25% left over. That's my goal. All right. And you say, wow, that's something. Yeah, that's the way I do it. Then we have 3 bank accounts. If you're married, you're going to have 2 bank accounts. If you're not, these are one is your account that receives all the money. We're going to set aside if you don't have debt, bad debt, meaning consumer debt, you're going to probably do some things already that before it gets to your checking account, like your 401k, get your matching funds, stuff like that done, so you get some tax benefits. But the point being is that all the money goes in one place. Then we're going to automate all of our bills. It's going to either be bill pay or automatic draft, whatever it may be. So then right now at the beginning of the month that there's going to be $3,000 a month going out. We know where it's going. That's what's happening. We know it, and it's part of the budget. Then from there, we're going to we're going to start looking at what do we need to purchase in the future inside the budget. We're going to have some future purchase accounts, vacation accounts, Christmas, all that kind of stuff. And we're going to allocate it on paper, but we're not going to end up doing anything. We're going to see this account each month. This big draft account, what I call it, is just going to get bigger and bigger. And then you're going to say, well, we're going on vacation, so we're going to spend $3,000, whatever it is, $2,000, whatever the number is. And we've been putting aside $250 a month, and we're going to do that. And so then we're going to move the $3,000 into our other account, which is our spending account. And we're going to use that to do the vacation, and it'll be over with, and so on. We also have our weekly budget that we can set aside each week for our personal weekly expenses, putting gas in your car, eating out, all the different things like that. So we've got that going. So now we know each week on Sunday, we're going to move our money over there. And when we move it on Sunday, we know that we got $300 this week. And then I recommend, and I've been doing this for years, I get an email every day showing my bank account balances. And then that way I know where I'm at. And in your case, if you're budgeting monthly on a weekly basis, then all you do is you look and you say, how much is in this little spending account? Oh, it's got $100 left, and I got 2 more days. All right, good. So I got to live on $100 in the next 2 days. And on Sunday, you replenish it, and you make sure that you can't spend more than it's in there. All right, that's how you set a budget up. You automate all your savings. We would set aside money market accounts to set up your emergency fund, automatically draft, and then we start going toward saving money for future purchases, maybe for your house, whatever it may be. All right, so we're doing that. So now we have a way of managing it to where our goal is 25% going to savings. We buy the proper insurance. What is the proper insurance? You need life insurance. You need term insurance to protect your income in case something happens. You might go ahead and start with a long-term savings plan with permanent insurance. That'll be something for a long time. The benefit is buying younger. It's cheaper. It's easier to qualify for. But term insurance is so cheap, especially when you're young. I mean, you can get a 30-year-old can get $1 million of insurance for nothing. I mean, when I say nothing, less than $100 a month, more than likely. And so you do that. You may be able to have disability insurance through your work. You want to look at life insurance now has living benefits that allows in the event that you get sick or you get terminally ill, you can get the benefit, a lot of it up front to help you with expenses during that time. We're going to get health insurance. If you're self-employed, I'll look at health share plans. As we build our emergency fund, we raise our health insurance deductibles. So we're building a defense right now. We're going to get liability coverage. We're going to get car insurance and personal liability coverage. We're going to look at our deductibles, raising that, look at not having a bunch of junk fees. You always should shop around and make sure that you get the right coverages. Insurance companies are funny. They like certain markets of people, and they give you better deals if you're in that market. And so what we're doing now, we got our insurance in place. We're going to get out of debt. If we have good debt and bad debt, there's two different types. Good debt is you can afford it. Number two, it's tied to something that goes up in value. So we're going to make sure that we are not financing depreciating assets. That's one of my rules of thumb. Don't borrow money on things that go down in value. Another rule of thumb, or a rule that I've made a point to live on, is don't pay taxes on money I'm not using. So what we're going to end up doing is if we have 1099s, we're going to limit that on our interest earnings, and we're going to put it into things that are tax deferred or tax deductible. That's why we recommend your IRAs, your 401ks, annuities, things like that allow you to save, okay, and grow it tax deferred. Then what we're going to do is we're going to get rid of the bad debt. How do you get rid of the bad debt? Step number one is you get your budget in place. That's the starting point. Once your budget's in place, if you have credit card debt, then what you're going to do is set up an automatic payment, not the minimum payment, but you're going to set up a levelized payment to pay your credit cards off. And how do you do that? Well, if you pay the minimum payments, credit cards refinance every month. So what they do is you pay down a little and your payment goes down, and you pay down a little and your payment goes down. And it's on about a 30-year amortization. That means that if you have credit card debt and you're paying on it and you pay the minimum payments, you're going to take 30 years to get out of debt. You're going to pay stupid amounts of money. So what you're going to do is you're going to set up an amount. Let's say that amount is $200. You set it up every month. You pay $200. If you have multiple credit cards, there's a lot of different ways of doing it. We've created, the debt snowball. That was something that Dave Ramsey and I did many, many, many years ago when we were on the air together. And the debt snowball is nothing more than you take your smallest debt, you levelize it, you apply all additional monies to that smallest debt. Once it's paid off, you take that payment and you add it to the next one. You pay minimum payments on all the ones that are out there and load up on one of them. It's a lot of different ways. You can cut interest rates, but the bottom line is you automate it. You set up an automation to where it automatically goes through. So we've covered 4 points. We've got 3 more. We got one more segment. Visit RoyMatlockJr.com. We'll be right back.
Welcome to the Roy Matlock Jr. Money and Business Hours, where he'll help you fix your finances once and for all. To reach Roy, call 615-843-2999. That is 615-843-2999, or visit RoyMatlockJr.com. Now, here's your host, Roy.
All right, last segment today, and this is pieces of getting started when you're just getting your financial plan together. And here's what I would encourage you to do. Go to RoyMatlockJr.com, and if you've got a few $100s a month, we will help you to get started. I love working with young people. We have young advisors as well that will be happy to meet with you and get the basics in place. I see people, they got new babies coming. Here's what I know. You got to have life insurance. You got to have term insurance. You need a will and a trust, in case something happens to either one of you. And the crazy part is you can do it for nothing. You can set up mutual funds for $250 and you're set. You get it started. I always encourage my clients that, they've got kids, get them started right. Okay. It'll change their life. I can't tell you how important it is to start young, do it the right way, that kind of thing. Go to RoyMatlockJr.com, schedule a 30-minute call with one of our advisors, and you also can download the budget forms, which is the key to getting out of debt. Eliminating bad debt, consumer debt is the first step to being able to free up money to save. So what we're going to do is we're going to go in and we're going to start doing things to free up money to save. That's really what we're doing. And when you're young and you get started, I can tell you stories, crazy stories. I bought used cars all the time. I went to the Ladies of Charity sale and bought suits when I was making real money. But I wasn't going to pay $500 back then for a suit when I could get them for $50. And I remember going to the Goodwill and buying brand new Pinpoint Oxford shirts, dress shirts for $1. Can you believe that? For $1, I'd walk in there and people that outgrew them, they'd take them and donate them. Normally the people that donate to Goodwill are people that are wealthy and they spend money on stuff. And so I was like, this is great. I'm buying everything used. I made a decision, when I wanted to get ahead, I'm like, I'm never buying anything new. I'm just buying everything used and let somebody else, pay for it. I remember going to hotels and negotiating with them and they'd give me a better deal. I still do that with the rental cars. It's just the way I am, because, it was funny. I was jumped in a cab just the night before last, and the guy, I know how they operate. I said, hey, I'll give you $20. No, 35. I said, no, dude, I live here. You're not going to do it from downtown Nashville. He said, okay, $20. All right. And so the point of it is that you work hard for your money. You don't want to throw your money away. Now, one thing I always do is I tip good, because if somebody gives me great service, I'm going to pay people that do a great job, but I'm not going to just throw my money away, because that's how the little dollars add up to be the big dollars. And you want to be thinking about watching the little dollars, and they'll add up to one day be big dollars. And then once you do that, you've got a nest egg that'll do it. So we're going to get out of bad debt. We're going to be moving toward, if you've got credit card debt, don't even think about buying a house. Don't think about buying a car. Don't do any of that stuff. Get rid of your debts. Get to a point where you have paid cash for your cars. So we're going to get our overhead down, which allows us to free up money to save. Then you go buy a house. And when you buy that house, you go in there with a mindset that it's a nothing payment. A nothing payment. If you have to think about it, it's too big. And just buy something less expensive, all right? And then pay it down a little bit. And then as your income grows, you can go move up. And then that's how you do your homeownership. So we do that. I talked about an estate plan. If you have kids, what is going to happen if something happened to both of you? What happens if something happened to one of you? All right. You need to have financial power of attorneys. You need healthcare power of attorneys. You need, guardians for your kids, all that kind of stuff. So you want to do that. That's called a living trust. You can get that. At the very minimum, you get a will set up and do that kind of thing. If you go to roymatlockjr.com, we have an insurance product that you can get up to $2 million of life insurance, term life insurance, instantly issued in about 10 minutes, maybe. And it goes through with AI and that kind of the deal. So you're not going to have to get blood or physicals and all that kind of stuff. And you can do that. And it also includes a do-it-yourself will and trust. How about that? So you can knock that out. So if you don't have proper life insurance, term life insurance is very inexpensive. Go to roymatlockjr.com, fill the form out, and we'll reach back out to you and literally quote it and issue it in about 10 minutes. And our goal is to get to $100,000. And so what we're going to do now, I'm going to roll out kind of the final getting started stage plan of action. All right. If you're just tuning in, you can go to roymatlockjr.com and listen to the podcast, which this will be on in just a few days. You can do that. I think we've got about 200 shows that are sitting in the podcast. Anything you can imagine that has to do with money, it's there. And so you do that, and that'll get you started on the right track. I had a person call in, and they came in for a review, and I said, "Hey, tell me, how educated are you on your money?" I mean, he said, "You know what I did?" He said, "I wanted to be prepared. I listened to all of your podcasts." I said, "All of them?" He said, "All of them. I've been doing that for the last few months. I didn't want to come in and, talk to you and not know what's going on." Well, guys, you don't have to do that, but if you start listening, it will help you. And one of the things that I've always believed, and this is going back to the first of the 11 points that, kind of cleaning it up, breaking it down, is grow your income by growing your skill set. How do you grow your skill set? I always grew my skill set by listening to things while I was driving that were productive. And what were productive things? Like now you can listen to podcasts. You can learn anything you want to learn by listening to a podcast. And so you do stuff like that where you're driving down the road. And if you say, well, I got an hour a day driving, why wouldn't I make my hour worthwhile? Well, what is an hour? Let's see. That's 365 hours in a year, 1,800 hours in 5 years. And you're just driving. You're driving to and from your job or to and from wherever you're going. And, you put 30 minutes to an hour a day into learning, and you'll be surprised what happens. Number 2, we're going to set up the budget. The budget forms at roymatlockjr.com. We'll also be happy to help you on that. If you want to schedule a 30-minute phone call, we help people get started. You set up and automate retirement plans. What that means is the 401k, we want to make sure and get the match. That's free money. You put in 3%, they may match 3. You put in 6, they may match 3. So if I can put in 3 and get 6, that's a good return plus a tax benefit. I'm going to set up my life insurance. That's going to be term insurance. I'm going to set up some permanent insurance. Maybe not to start, but at least get my term insurance in the event. I'm going to make sure that if anything happens to me health-wise, then I'm covered. All right, I've got my disability income. A lot of times you can get that through your job. If not, you can purchase it. Disability insurance, that's in the event that you get hurt and you can't work. All right, and I think becoming disabled is worse than dying because you can't take care of yourself. And so we look at our health insurance. It's inexcusable to not have health insurance, especially because it's so cheap when you're young. I mean, for $100 a month, you can get health insurance. I mean, and you can get health shares and all these kind of things. And then we go in and we buy our car insurance. What do we want to look for in car insurance? As we get an emergency fund, we raise our deductibles. We want to make sure that we have enough liability. Typically about $300,000 is a good number of liability coverage. That way, if you have an accident and it's your fault and you run into a expensive car or you damage something bad, you've got liability insurance. So if somebody sues you, that's what happens. And it allows for you to be protected. If you rent, you want to do the same thing. You have your renter's insurance, you have your homeowner's insurance, you have your liability coverage is raised on your all your property and casualty coverage. That's home, your auto, your renters, all that kind of stuff to make sure that no one. I got sued one time, had a wreck. It was my fault. It was not. I mean, I rolled into the back of a delivery truck, and I had a Mercedes, and so I'm sure the guy looked and said, okay, Mercedes, my back is killing me. I can't do nothing. All right, sued us. I turned it over to my personal umbrella. My insurance company had a personal umbrella policy. It's a cheap lawyer is what I call it. A cheap lawyer is you pay $500 or $1,000 a year for an umbrella. That's an extra liability policy. And then the insurance company called me up. They said, hey, what happened? I told them. I met with them about 45 minutes. Then after that, they asked for my cell phone records. I sent them that. And it went on for 2 years. And it got settled. And that was the end of it. Cost me $500 a year, I think, or $1,000. I don't know what it is right now for a personal umbrella, but it's not. It's the cheapest lawyer you can ever get. It's a personal umbrella policy. We're going to eliminate bad debt, and once we eliminate bad debt, that's going to allow us to be able to start saving money. We're going to automate the savings. We're going to set up and automate all retirement plans, mutual funds. Then at that point, if we have children, we're going to set aside money for your kids' college. You can do 529 plans. You can do educational savings plans. You can do UTMAs in Tennessee. That's where you're gifting. I remember I was so excited when my daughter was born. That was 33 years ago, and I could not wait to set that college plan up. And as a result of doing that, she went to a private four-year college, and we had set aside money, and it was paid for. We didn't play with those student loans, and I did that for all of my kids because I started young. I understood the magic of compound interest, being able to do that. And when you start thinking like that, you look differently at your money. What you want to be thinking about is, why would I work my entire life and struggle when I'm making money. Set aside some money, have a plan to set up things where you're on track. Money is no different than anything else. If you manage it, you get better. If you manage your health, you get better. Everything is about management. And so I hope today's show has been good. We are talking about getting started young. You want to start a plan out. If you have kids or grandkids, send them to roymatlockjr.com. Get them to listen to this podcast. I think it's very important, that you pass it on to the younger generation. We have a couple of things that we can do to help you. Number one, if you're wanting to get started with a financial plan, we can do that. We have advisors that will work with you. We also have plenty of resources on our website, roymatlockjr.com. Also, we have upcoming events that you can attend. Bottom line is, we're all about money. My name is Roy Matlock Jr. Thanks for listening.